Zion's Bancorporation reports Q2 2026 earnings after the bell today. The stock has run 22% year-to-date, hit a new 52-week high last week at 73.34, and is carrying a 6-quarter earnings beat streak into this print. The options market is implying a 4.8% move, which means the stakes are higher than the whisper numbers suggest. I am Daniel Reed, and this is your Market Lens earnings preview. Here is what analysts are looking for. The consensus calls for earnings of $1.57 per share on revenue of $877 million. That would represent roughly 18% year-over-year earnings growth compared to the $1.33 per share Zion's earned in Q2 of last year. Revenue is expected to come in around 3% higher than the same quarter a year ago. But the headline numbers only tell part of the story. There are 3 variables that matter more than the EPS beat or miss. The first is net interest income and margin. Zion's has been a beneficiary of the higher-for-longer rate environment. In Q1, net interest income rose 7% year-over-year to $630 million, and the net interest margin expanded to 3.32%. The question for Q2 is whether that momentum held through a quarter that saw the first Warsh-era FOMC meeting, a spike in oil prices following the Iran ceasefire collapse, and ongoing uncertainty about the rate path. If NII came in above $640 million, that signals the net interest engine is still firing. If it dipped below $620 million, the market is going to start pricing in margin compression. The second variable is credit quality, specifically commercial real estate exposure. Zion's has roughly 30% of its loan book tied to CRE, concentrated in the western United States. That is higher than most of its regional bank peers. The market has been watching this metric since the 2023 regional banking crisis, and it has not gone away. The question is whether non-performing assets ticked up. In Q1, net charge-offs were 12 basis points, historically low. If that number stays under 20 basis points, the CRE concern stays theoretical. If it jumps above 30, the sell-off will be sharp. The third variable is the buyback. Zion's authorized a $225 million share repurchase program earlier this year. The question is not whether they are buying back stock, it is how aggressively. In Q1, the buyback contributed roughly $0.03 to EPS. If management accelerated the pace in Q2, that signals confidence. If they pulled back, it signals caution about the operating environment. Here is why this matters beyond the Zion-specific story. Regional banks are the canary in the coal mine for the U.S. economy. Zion's is not the largest regional. It is not the most complex. But its Western U.S. footprint, its CRE exposure, and its rate sensitivity make it a useful proxy for how the mid-tier banking sector is handling the transition from quantitative tightening to potential easing. If Zion's beats and raises, it confirms that the regional bank recovery that started in late 2025 has legs. If the beat is driven entirely by buybacks rather than organic loan growth, the market will look through it. And if they miss on NII or show credit deterioration, that will ripple across the entire regional banking sector. The stock closed Friday at 72.27, down 1.4% in a session where the broader market was digesting the Samsung sell-off and the Iran headline cycle. The options market is pricing a move of roughly 3.50 in either direction. Historically, Zion's has beaten expectations in 6 of the last 6 quarters. The average beat has been roughly 12% above consensus. But past performance does not guarantee future results, and this quarter carries more macro uncertainty than any of the previous 6. The call is scheduled for 5:30 p.m. Eastern. I will be back with the full breakdown after the numbers hit the tape. I am Daniel Reed. Keep your data sharp and your logic sharper.